Welcome back to Dukascopy TV. The Bank of England's rate setting committee kept interest rates at 0.5% yesterday and rejected calls to inject more stimulus into the economy. To discuss the decision and the future of stimulus in the UK, I'm joined down the line by Alan Clarke, Economist from Scotia Bank. Alan, this decision means the Monetary Policy Committee has now kept rates at historic lows for 4 years. But opinion was widely split as to the outcome of yesterday's meeting. Was it the outcome you were expecting?
I wasn't. I thought actually there was a decent chance that the Bank of England would do something. I certainly didn't think they should cut interest rates or the interest that they pay on reserves held at the Bank of England, so I thought that would backfire. I think if you cut interest rates, it would have hurt the lenders, building societies and banks, and they would have retaliated by pushing up their existing mortgage rates. That would have affected probably 90% of borrowers. It would have hurt their disposable income they have to spend on fun stuff like iPads and clothes and cars and things like that, and would have actually hurt the economy. What I thought they would more likely to do is more quantitative easing, because the governor and 2 others voted for it last month. And there's been lots of talk from MPC members since then, so I thought there was no smoke without fire, and maybe they're moving that direction, but clearly it wasn't to be. So we'll find out a few more details in the minutes of this meeting in a couple of weeks' time, but I was a little bit disappointed by the outcome.
What do you think it would now take for the Monetary Policy Committee to take more action to kickstart an economic recovery?
Well, in terms of the economic data, there's already a decent case because we're just not growing. The margins, this morning we had some construction data in the UK, which makes it more likely than not that we'll be in a triple-dip recession when we get the data for the first quarter of this year. That at the margins may make it mildly more compelling for the committee to deliver more quantitative easing. But that aside, the other key triggers could be if the Eurozone stresses return, or maybe when the new governor comes and he's more proactive and he leads the charge towards more policy ease. But that won't be until July and probably August more likely, when the new governor has his legs firmly underneath the desk.
Do you think the slump in consumption from PMI activity and negative manufacturing data could lead now to further QE?
Well, those data are already weak enough to justify more quantitative easing right here, right now. The economy is pretty much stagnant. So that case probably doesn't build much more. The thing that's getting in the way of more quantitative easing is doubts that it actually does anything. The Bank of England's done about 25% of the size of the economy in terms of quantitative easing, which is not quite, but almost double what the US has done, and a lot more than the Eurozone has done. And we're still not growing. So maybe it's been a damage limitation exercise and it's prevented the situation getting any worse. But I think what's holding them back is, wanting to do something, but they don't know quite what, and some doubts that actually more quantitative easing will have any benefits at all.
Let's take a look at the currency. We have seen sterling declining and could see inflation rise as a result of this. But in the longer term, could a weak sterling have a positive effect for the UK economy due to its impact on exporters?
I think a purist, academic-leaning economist, such as some of those on the Bank of England Monetary Policy Committee, would say, this is going to be good for growth because we need rebalancing, we need to export more and depend less on imports, and has some sympathy because one of the biggest drags on economic growth last year was UK consumers and businesses sucking imports into the UK. But right here, right now, the weaker pound is pushing up petrol prices and other imported costs. Higher inflation hurts people. It hurts their spare disposable income, and they'll spend less, and it will hurt economic growth in the coming quarters. And maybe I'm a bit more impatient than most. I'd rather see growth better now rather than later.
In David Cameron's speech yesterday in Yorkshire, we heard him dismiss plans for increased government borrowing to fund capital investment and warned of the dangers of pushing up interest rates. The government are hearing calls for change from all sides. Will they stick to this current plan? Are we likely to see any changes in stimulus this year?
Well, this is becoming more a political thing than an economic thing, a market-driven thing. I've changed my view a bit. I think the biggest evil in the economy right now is inflation, and a great way to get inflation down is to cut the VAT rate. Now, I don't think that was appropriate for the last few years because we needed to get the benefit of the doubt of the financial markets and the rating agents, which we, to a large extent, we still do. Okay, we may have been downgraded, but we're not a sick horse in the glue factory with a least pretty bridesmaid at an A-list wedding. We're still very high quality. I think if you cut VAT, yes, it does reduce tax inflows, but it stands a very good chance of boosting growth through consumer spending. It actually reduces the government's debt interest burden because inflation is lower and it has to pay less interest on its inflation-linked debt. I think we've gone through a few years of austerity. We're making good progress. I'm not saying completely abandon it, but if the rating agents are downgrading us because of lack of growth and the situation's getting worse, not better, try tweaking it. But as I say, it's political, and if they were to cut that or loosen things, the Labour Party opposition would say they'd claim a victory.
Thank you to Alan Clarke there from Scotia Bank for his insights into the Bank of England rate decision. We'll be back on Monday with more updates. Have a great weekend.